It's a great day at Equity. Today we're going to talk about cash out refinance options. What are they, how do they work, and some things you need to know to qualify. Let's start with what a cash out refinance is. A cash out refinance is a type of mortgage that allows you to take out a loan for more than you owe on your current mortgage. The lender hands you the difference in cash minus any closing costs. You pay back the new loan over time, usually between 15 and 30 years. Your home acts as collateral on the loan, just like with a regular mortgage. Cash out refinancing lets you access your home's equity through a first mortgage instead of a second mortgage, such as a home equity loan or a line of credit. You can refinance to achieve any of the following financial goals. Lower your term to save money on interest. Use the money received for debt consolidation like paying off credit cards, student loans, or your car. Use it for home improvement or repairs, or start an emergency fund or your child's college fund. The equity you've built in your home is there for you to take advantage of. Around the holidays, a cash out refi can give you extra spending money in your pocket instead of overloading your charge cards. Expect the following minimum lender requirements to apply for a cash out refinance. You'll typically need to have your home appraised before you can cash out the equity. Appraisal values can impact the amount of money you can extract from your home, as they establish the home's value and give your lender your loan-to-value ratio. Your lender will notify you if a full appraisal is needed or if there's an alternative method. The loan-to-value ratio, or LTV, compares the size of your mortgage loan to the value of your home. For example, if your home is worth $200,000 and you have a mortgage for $160,000, your LTV is 80% because the loan is 80% of the total price. You'll need to retain at least 20% equity. You can borrow the difference between your mortgage balance and up to 80% of your home's market value. You need reliable income to show you can afford your new loan's monthly payment. Your debt-to-income ratio, or DTI, ideally should be 43% or less, with your monthly debt payments such as housing costs, credit card debt, and student loans comprising 43% of your gross monthly income. However, there is some flexibility with this percentage depending on your specific loan scenario, so this may be something your mortgage specialist can help you look at more closely. A cash-out refinance can be a fantastic way to take advantage of the wealth you've built into your home. Reach out to one of our knowledgeable mortgage specialists today to learn more. Thank you for joining us. Don't forget to like this video, subscribe to our channel, and turn on our post notifications to never miss a new video. Please leave a comment below if this video was helpful and if you'd like to see more videos on similar topics.